Good afternoon, Mr. and Mrs. Hess. It's great to see you again. Today we're going to review your financial plan in which I had put together for you. In recap, our previous meetings, I had gathered information from you from assets, liabilities, your insurances, annuities, and life insurance, all included under the insurance. I gathered information in regards to the sale of the business, which resulted in the note and the down payment, and worked through a lot of different things to come up with today's recommendations of us moving forward. Additionally, the financial plan is just the start of your journey in this next stage of your life. It is to help us benchmark your investments, your finances, your goals to what this journey is going to be. The market will fluctuate throughout this time. Your goals might change throughout this stage of your life, and things don't always go as planned. And so having a financial plan is important, as I had stated before. It helps us adjust and make changes to your cash flow, to your investments, to your goals, whatever the case might be, to stay efficient and aligned to the long-term success for you guys in this stage of your life. Now, I don't have all the answers. However, I know where to find answers, because things will come up that we aren't sure on. But it's our job just through regular review to regularly checking in on the financial plan to make sure that we are making the best informed decision together for you. So, today, as you can see in front of you, you have the financial plan. We're going to talk some highlight stuff, and I'm happy to answer any of your questions, not just at the end, but throughout, because this is your financial plan, and my job is to help you ultimately achieve or pursue your financial goals in a manner that is prudent and realistic for you, as well as comfortable. So, roughly based off of your income, all income sources you have coming in, you roughly have an income of $651,893. With that, after paying your annual expenses, lifestyle currently, you have a net income of $284,472. And let me rephrase, disposable income of $284,472. What is this? These are funds you don't necessarily need to maintain your current lifestyle from all your current income coming in. Now, it's important to remember, and this is where the financial plan comes in and regular review, the installment loan you have coming in because of the sale of the business is only for 8 years. And so we need to be mindful that the closer we get, and that income is not going to be coming in as time goes on, and so that will adjust this a little bit, and so we want to make sure we stay on top of it. However, with this disposable income means you have a lot of things you could do with it, and it ties into one of your goals, and I'm going to address it a little bit later in this conversation. Your net worth is approximately $10,579,900. This also, in regards to one of your goals, is addressing estates and how do we be efficient and reduce the tax liability when it comes to your estate. So, initially, as it stands, your estate as a married filing couple filing jointly is less than the roughly $23,000, $24,000 of what the current estate limit is for a married couple. So there is no estate tax on it at this standpoint. However, it is cognitive for us to be aware if something was to happen to one of you in the near future, and though their survivor lives on, we would then be pretty close to that limit of the estate, having an estate tax for an individual. So we definitely are going to want to focus on that and have more of a conversation with your CPA and your attorney. But I do have a suggestion which I'll address in a little bit. But I wanted to point that out. Right now, you have a very, very nice estate. It's not as high where we have to worry about as a married couple for an estate tax. However, in the event something was to happen to one of you, it would come into play that we would be on the verge. Not saying we would be, because it does change every year, but it's something to be mindful of. A potential estate tax. So we want to maybe address that. Your time horizon is 10 plus years. And why is this important to remember is not just from a risk standpoint, but also an allocation standpoint. And the fact that though you are retired, we want to make sure the money lasts throughout your retirement for all things that come up. Being one of the biggest things is your health care. Health care is going to play into your later years, and not everybody's created equal, so those later years could be 5 years from now or could be 20 years from now. But with longevity increasing, as well as the cost of healthcare increasing, we want to be mindful that we are living a realistic lifestyle today, but that we have assets that will help us pay for some of the things we need in the future when that time comes. Now, it may not come, but it's best and prudent to plan for it. So I always look at, though you have a 10-year time horizon, you do have retirement supplemental needs today. From a risk standpoint, you guys are open to more risk, meaning you don't necessarily have to be overly conservative. Your current portfolio, for the risk for return it's getting, is better than the market. So I have you guys down as roughly a growth-oriented risk tolerance, and the reason being is that note you have from when selling the business. To me, that's a fixed income alternative. That fixed income alternative isn't just an alternative to, say, bonds in your portfolio. Because of that size, we're able to stay more aggressive than in your actual stock investments. Stock mutual funds is what I'm referring to. We don't have to be overly conservative because we have this note. But it's mindful that note expires in 8 years. So roughly 4 to 6 years, probably right around that 5-6 year, we should start reducing the risk exposure in the stock/mutual fund portfolio to be more conservative. And when I say be more conservative, I'm not saying go from, a riskier standpoint and go to cash. No, I'm not saying that. There are definitely steps in the process. And so what I think we need to do is reduce roughly in about the 5-year standpoint, where we about have 3 years left, reducing the stock mutual fund portfolio from a more aggressive standpoint or growth focus, which is about an 80-20, to something more like moderate, like a 65-35. Now, you might be familiar throughout the years, the 60-40 rule. Why I didn't say 60-40 for a moderate is because lately, in roughly the last 5 to 10 years, the 60-40 rule for a moderate allocation has changed. We've been in a very low interest rate environment up until recently. And so with that said, a little bit more tilt to equities and a little bit less to bonds would be more ideal. And so that's why it's that 65-35 allocation. In my experience, in my opinion, is more of a realistic of what the new current and forward-looking moderate allocation would be. So we would definitely, in about 5 years or so, or depending on as things change, look to reduce that, your current overall stock and a mutual fund portfolio, to be more of a moderate exposure, especially with the closer we are with that note expiring. Cash flow requirements. Well, like we talked about earlier, you have plenty of income coming in to cover your expenses and your lifestyle. That's a good spot. What we could do right now is, with that disposable income, do multiple different things. One of your goals was to reduce personal income taxes. So what we could do and this ties in also the gift tax liability, is we could look to take some of those funds, your disposable income, and maximize your gift tax free amount to family. Now, there's multiple ways we could do this. We could do it annually. We could do a 5-year all at once to all of them, if that makes sense financially for you guys. Or, we could just pick and choose who might need it more and just do some gift taxing. From there, I think what we should also do, and it won't hurt, is look to invest some of these funds and treat not only these funds, the disposable income, but the income from the note, as you mentioned, that you'd like to invest those as it comes in rather than just spend it. We could use that to fund in a separate account and potentially a separate trust that would ultimately be your health care or your long-term care policy. This way you self-fund up front your healthcare needs in the future in a trust that would basically cover that, but also by earmarking these funds, because the rest of your wealth and the current investments are adequate to help supplement potential any additional needs when it comes to your lifestyle. But by earmarking the disposable income as well as the installment loan to focus on investing for your future, it will actually help you self-fund and not pay for a premium for long-term care insurance, which in turn, if you spend that and you don't do it, you potentially don't get it back. Here we can set it up where it's in trust, it's earmarked specifically for your health care. Let's say you don't use it all, or you don't need it because let's say you pass away without needing extended health care. It's in trust, a specific trust, then it reverts to giving to your kids or your family or however you want to gift. And I think this approach will earmark this separately in the portfolio, and that it will remove the stress of, well, what do we do for either one of you, whether it's one of you or both of you at the same time, because it can happen. I think this is a very prudent approach to saying, hey, how do we manage that from the disposable income, like I said, and the income we get from the installment loan over the next 8 years. If we do that, we front load it, and that's specifically for that. And we potentially invest it slightly more moderate, treat it kind of like an endowment approach where we're trying to grow it, but not aggressively grow it, but in a way that in about 15, 20 years, whatever the case might be, that has grown and we could peel money off of it to pay for this cost of healthcare or assistance. And I think it's just a very prudent and unique way to look at it, and I think it aligns with some of your concerns that you have voiced in the previous meetings. In regards to a diversified portfolio, hands down, a diversified portfolio is the way to go. I approach it kind of like I just said, like an endowment. We have short-term needs, that's intra-year, over the next year, to 18 months. Then we have that about year to 3, year to 5, and then we have 5+ years, so that, further on in the future. So what I think in having a diversified portfolio is that we make sure we have needs and we're able to fund it, and then the longer term eventually will fund the more intermediate funds the short term. And having a diversified portfolio will do that. I particularly like investing in ETFs. ETFs tend to be more tax efficient. They do have a lower internal cost than mutual funds, so I find it more prudent. And it's a far easier approach to managing from a passive and ongoing process than the active management regularly of mutual funds, especially if there's some issues involved with the managed and actively managed. And just looking back, actively managed has not necessarily added enough alpha or management value to really make the case against passive investments like ETFs. But I would look to want to invest more in that rather than single stock investments, because You'll still be invested in those stocks inside the ETFs, because the ETFs are like a basket of stocks. But we're not going to get hung up and carried away. Say like, oh well, Amazon this or Apple that, or whatever the case might be of a stock. It removes a little bit of that emotional connection, so it's easier to make decisions and changes that are prudent to you and both of your situation. And we just, we can make informed decisions together. I can make the proper investment decisions or proper suggestions, and you will do it from there. And it's not being, in my term, married to a stock, because I have found clients sometimes get attached to certain individual stocks, so it's harder to part ways with it, but it is needed to ultimately fund their goals. So the ETFs allows us to still have that exposure to those underlying investments without having that emotional attachment to an individual stock. So I do like them better than individual stocks, for the case that it diversifies us more. We're not, potentially having that emotional attachment to the stocks. In addition, I find them to be more tax efficient, as well as cost efficient compared to your mutual fund portfolio. So we still do that. Once again, like I already stated, we would be a little bit more equity focused over these next 5 or so years, 4 to 6, to give you the actual range, and that can change based off of the needs or if they pay the loan sooner. But yeah, I'd be a little bit more aggressive, the 80-20 right now, but the closer we get, we move it to the note expiring or coming due, we would become more moderate focused on it, and we would do it gradually where it's efficient. So a restatement once again of your goals: reduce estate and gift tax liability, review insurance contracts and recommendations, reduce personal income taxes, and recommendation of a diversified portfolio. We just addressed a diversified portfolio. We've talked a little bit about the estate and gift tax. I feel that your current retirement post the sale of the business is realistic. The key thing here, once again, is managing some of that disposable income and the installment loan to reinvest in a way that's going to address potential future health care. And I know that wasn't a huge thing as a goal, but a lot of times people overlook it, or like, I'm healthy now. I'd rather plan for it and have the conversation, and we can adjust accordingly. Your current stock portfolio, and this is why I'm okay with staying that's a little bit more aggressive in the ETFs, we can compare a little bit to it as well, is your current allocation has outperformed the market for less risk, so it has a better risk for return, which I definitely like. You're not taking on as much risk. You have a better, a good return in response to the risk that we're taking in relation to what the overall market has done. And at the end of the day, that's what we want to try to do. How do we manage and minimize your risk exposure, but try to maximize return for the risk we're taking? So we still can do that via an ETF rebalance and through an ETF portfolio with the amount of risk that you're taking. All right. In regards to the estate and the gift tax, is we need to approach this via trusts. Because what we want to do is protect your assets. We want to protect your assets in the event anything happens in the future to either one of you, but it will help us create gifting and gifting abilities via certain trusts, not tax, but special trust, certain trusts that will make sense in when we pass on your wealth to your heirs or in your family. It is tax efficient. However, I'm not a legal advisor. I can't give you legal advice and sit there and say this, that, or another. However, we need to work with your attorney. And if your attorney doesn't feel comfortable in the state, we look at, getting an estate attorney involved, that we formulate multiple trusts that we'll fund, whether we fund now or we fund later, to create and protect your estate, not just today but in the future. The one I definitely think we should do, there's 2 trusts for sure I think we need to do now. One is just is a family trust. It's a Mr. and Mrs. Hess revocable living trust. We definitely need that. Really put things in paper, really put stuff down, start getting that funded. the kind of the in that trust, in turn, we could always amend and talk with an attorney, amend where it builds in, if something happens, these other trusts are created based off of it. And that's possibly how we'll go. I'll leave it up to the state attorney to do it. Another trust that I think we should do and look at strongly is looking at a life insurance trust and funding it with the current life insurance policies that you have, so that it ultimately goes according to who you want it to go to. But what I want to do before we really kind of like navigate that is to sit down and have a one-on-one meeting, meaning you guys, myself, and your estate attorney, to really talk through this and figure out what it best is, and leave it up to your estate attorney to really say which trust we want. Obviously, I can give my opinion, input, so that we can formulate the best case scenario for you. In managing the tax liability, this is a little bit more complicated, a little bit more involved, because your tax situation is going to change every year. Heck, in 8 years, you're not going to have the note anymore, which is not income you're not going to have. This is where we need to work with your CPA. We need to work with your CPA, and it's not just once. We need to work continuously working with the CPA. Obviously, give me certain permissions and him or her for certain permissions in which we can talk to each other for you, so that when we come to meetings, we've already discussed and have a plan in action. With that said, it's an ongoing annual thing. The taxes are going to change depending on what the government does this year, next year, 5 years from now. The current tax laws that were passed in 2018 are expected to expire at the end of 2025. Unless anything changes, it's going to revert back to what the tax situation was in 2017 or 2016. So with that said, we need to be mindful of these things and approaching this in a tax efficient way. And it starts with us working closely with your CPA so that we can do this on a year by year basis. However, I think it is important to note that you have quite a bit of income, and to maybe reduce some of your taxable stuff is looking at gifting, and gifting now rather than waiting, because this is where a tax liability I have issue is, and I mentioned it already earlier, is if something was to happen to one of you, the survivor would be pretty close to what the estate tax is. So it's one of those things we should start looking at doing some gifting now, whether that gifting is to heirs, charities, all the above. We should start looking at a gifting strategy for you now to potentially mitigate some of your estate, so that if something did happen to one of you and we had a survivor, we're not too close to that amount. Now, once again, the estate tax size will change. Right now, you're far off from it if you're an individual basis. You're definitely well below it from a married couple. But I think creating a gifting strategy that is, and potentially a trust that can do this for us, and we fund it that way, the gifting will help reduce a little bit, but we can't do it where it's leaving you guys shortchanged and you can't cover your expenses. But once again, this is working closely with your CPA. With that said, I want to move forward in doing regular reviews. And when I say regular reviews, part of our financial plan process that we had talked to you about prior is that we would manage your investments. Now, it's not me or our team managing your investments without you. It's with you. But what we're doing is we're shouldering some more of the stress on the day-to-day basis and ongoing, and then we're meeting regularly to meet with you to address what's going on in the market, how are the stocks, the investments doing up, down, sideways, how does that affect the financial plan, as well as any changes going on. This way you guys can just enjoy this stage of life, not stressing about, oh my goodness, what's the market doing today? What's it doing tomorrow? How are we going to be able to continue to do this? That's our job. Our job is to handle that stress, is shoulder that stress. Now, you're still going to stress a little bit, but if we set up regular reviews, which is probably the most important thing in the financial plan process, in my opinion, we'll mitigate a lot of that angst, that uncomfortable, viewing of what the market did, or what being at a picnic or a family gathering, a retirement party, whatever, and somebody says something, you will remove that angst, that stressor of, oh my goodness, the market did what? Am I going to do this? Because regular review, we will talk about it. We'll regularly discuss how the financial plan is being adjusted. We need to make adjustments to it to meet your needs or align to your new needs, and kind of go from there. And then you guys have peace of mind. Now, it does not mean you won't have a negative month, week, quarter, year. It's going to happen. However, it will take into account the volatility of the market, as long as we're continuing to review it. So, next steps, I would like to consolidate your investments, rebalance the ETF portfolio, schedule ongoing reviews. We could do it as little as every 6 months, 4 times a year, which is every 3 months, or we can do it every 4 months, or 3 times a year. I'm very open to it. I pre-schedule all of our appointments. Additionally, I want to schedule an appointment with your estate attorney and your CPA. Ideally, let's do it all together. Let's just all collaborate, because your CPA, your attorney, and myself, we're your 3 trusted advisors. Let's just host one giant meeting. We could do it here. We could talk to one of these, but let's do that so then we can wrap our hands around you guys and your tax situation and your estate situation, and your managing your finances to your goals accordingly. And if we do that, and we do that start from the beginning, it's going to be a fine oiled machine for you guys a year from now, 2 years from now, 5 years from now, well beyond. So that's my advice. That's my recommendation. And that's my review from the financial plan standpoint. It's a pleasure, and I'm honored and look forward to continue working with you guys.